I think partially right, partially wrong. So for example, even myself, like if you said, how high do you think the Fed's gonna be able to tighten interest rates before they start causing problems? My number was probably around 3%, but they've already been able to get up to 4%. I think part of it was how quickly they did it, because as I mentioned before, a lot of this operates on a lag. So it's almost like there's very little difference. If you go to like 0% to 3%, like in 1 year, or 0% to 5% in 1 year, that almost doesn't make a difference because refinancing activity came to a halt pretty much. And so it's almost like that extra number barely matters in the near term. Where it starts to matter is quarter after quarter as this plays out. That's where I think it starts causing issues. So I think it's a matter of time rather than just height in terms of interest rates. It's always hard to measure how much kind of excess liquidity is still in the system, right? So people got stimulus checks, they got child care tax credits, PPP loans that turned into grants. So basically millionaires were given, another like $500,000, things like that. And that's just money that's kind of like sitting there, and they kind of like drain that out over time. It starts to getting diffused throughout the economy. And so some people had higher savings rates or, higher savings stashes stored away than I think some analysts realized. And so, I think quarter after quarter, it gets harder. The comparisons get harder from prior quarters as some of the conditions, basically as conditions stay very tight. So I think that's probably one way to look at it, that, these things take time. And then also the way I was phrasing it was the Fed can tighten, but they can't normalize, which is that, a lot of people are like, oh, there's too much debt, the Fed can never raise rates. And it's like, well, of course they can in the short term, right? I mean, if you look at, for example, US debt, the average maturity is something like 5 years. Now it's somewhat front loaded because you have 30-year debt on one hand, and then you have, trillions and trillions of dollars in T-bills, which is, that all refinances within say a 2-year period. And so, if they raise rates to 5% overnight, it doesn't mean that all US debt is now 5% higher. It basically means that, starting with those T-bills, some of the existing short-term debt starts getting refinanced at higher rates. And then it turns into the 1-year and the 2-year treasuries. And it's basically more of that maturing debt gets refinanced at higher and higher rates. And so there's a very big difference between, say, holding rates at 5% for 5 years versus doing it for 1 year, because more and more of that debt gets refinanced at that higher rate. And so the way I would phrase it is that the Federal Reserve is unlikely to get back to a period of positive real rates and then maintain it for years. But they can get to either positive rates in the near term, or they can get up to higher rates while inflation is still high. So for example, what's remarkable is that as much as the Fed has tightened, they're still below the official inflation rate year over year. And so they're still in negative real territory. Now they are higher than inflation break-evens, which is, supposedly the market's estimate of forward inflation. So they're positive in that sense, but they're still below trailing year-over-year inflation. So they've tightened, but it's not like they've done like a Volcker or 1970s thing yet. That's kind of how I'd phrase some of those aspects. So I think that they might maintain levels that long. I mean, the market and even the Fed's already kind of pointing to early 2023 is when they're probably going to start topping out in terms of their rates. And then the question is, how long can they hold it? And then that will largely depend on whether or not a recession materializes or not. I mean, if a recession starts to materialize, they're going to get a lot of pressure to pull back. If a recession manages to be narrowly avoided, let's say China reopens hard enough and the weaker dollar around, gives enough countries around the world a boost to kind of, hold up the equilibrium and we kind of narrowly avoid a recession, then you can stay tighter for longer. There's also, if inflation returns and the Fed is still holding rates, within say 100 basis points of where they are, you can have an environment where they're actually not that tight on a real basis. And so I think that the question becomes, what are they going to do with quantitative tightening? So you could potentially hold rates where they are, but then stop selling bonds, for example. That's a way of slowing down your tightening while still trying to be somewhat tight. So I think there's like kind of a range of options that they can do. It's still not fully clear how that's going to play out. I think that eventually they're going to run into problems with the treasury market where, you can't have a strong dollar and the Fed continuing to sell bonds. So far in the second half of the year, because the dollar weakened and because they drained the Treasury General account a little bit, they've been able to keep selling bonds. But if you don't have those variables, let's say in the first half of 2023, then I think the Fed's quantitative tightening gets pretty challenging for them to maintain. So overall, I think that they're going to maintain some degree of tightness throughout 2023, but exactly how tight will partially depend on what happens with recessionary conditions. while also keeping in mind that it's not as tight as you'd expect given how high inflation is relative to some of those rates. So one thing I'm looking at is Purchasing Managers Index, both the US one specifically and then also other countries, because that kind of gives you a good sine wave of is the economy expanding or is it contraction, especially the manufacturing side of the economy. So services tend to be more recession resistant, right? So hospital workers don't generally get fired in a recession, for example, whereas say manufacturers often do. You often have that more cyclical type of slowdown. So one is I'm looking at those more cyclical aspects of the economy. I also then look at things like freight index, like how much stuff's being transported around, because that impacts how many drivers you need. That impacts warehouse usage, all sorts of things like that. So I look at that kind of chain of behavior there. I also look at unemployment. So historically in the U.S., if unemployment rises by 50 basis points, meaning 0.5%, like if you go from 4% unemployment to 4.5% unemployment, if you get that much, it never stops there. It just keeps going up for a period of time. And then you kind of get this like spiral into recession. Maybe, they're kind of expecting this time's going to be different. If you look at the Fed models, they're expecting higher unemployment, but not way higher employment. Historically, that's been something that doesn't really happen very often. Another thing I look at is that because this recession has impacted higher wage workers more, actually. So there's been a shortage in things like, say, food workers, and a lot of people losing their jobs are like tech workers, Silicon Valley workers. A lot of those people have severance packages, and so they don't go and apply for unemployment right away. And so it doesn't necessarily show up in the, say, initial unemployment claims data as quickly as it would if people in the working class or the lower half, the middle income class gets laid off. And so I think that can slow down how that shows up in the data. And so, but I'm looking forward now to 2023 to see if we start to get more unemployment rate ticking up. And so that's what I would look at, the combination of PMIs, unemployment, and things like that, as well as the Atlanta Fed does a pretty good real-time estimator for what the quarterly GDP is going to be like. So in this quarter, they've been tracking what they think it's going to be by the end of the quarter, which of course isn't reported till the next quarter. All throughout next quarter, they'll be tracking it, which again, we won't find out till quarter two what quarter one's GDP was. So I look at that as a somewhat real-time estimate for at least the direction of where things are headed as this kind of plays out.